got Nissan Joseph joining in on the show right now, CEO at Metro Brands. Mr. Joseph, great to have you on ET Now. You recently reduced your revenue guidance to about 10 to 15% and Q3 growth as well, which is now nearing the lower end of that band. Tell me, what's the outlook going forward? What is it that you're anticipating for both Q4 as well as FY26?
Right. So I think we came into Q3 quite well, as anticipated. The good news is that the categories of footwear that should have performed through Q3. And we've seen a steady increase as we normalize this year, compared to Q1, built on Q1, went to Q2, and then Q3 was a double-digit growth for us. And what's more exciting for us is that the growth also flowed through to our EBITDA, as our EBITDA was up 13%, and our PBT was up 18% year on year. So, the numbers are looking very strong and good. As we go to the fourth quarter, typically we maintain a guidance of a CAGR of 15%. So in a CAGR, you're going to have some years that don't quite come up to that mark. And this year has been a challenging year. But the good news is, we're now back on trend to be at least on the 10% range plus going forward. And we see that continuing. So I believe that the demand, the normalization is all starting to feel like good retail again.
Taken. So that's about the Q3 setup. But the good thing this quarter was also the fact that the EBITDA margins improved a bit. They came in above the mark of 32%. Do you see this margin level being sustainable, or there are further levers to grow it from here on?
Well, I think we've always guided that we want to be at the 30 plus range, and I'm very pleased that we achieved that for the quarter. I don't think it's one of those things we look at and say that we want to grow that. We're of course going to look for opportunities, whether it's through cost savings or efficiency of investments that we make into our business. We're going to continue to look at that. However, let's not forget 30+% is probably industry leading.
In terms of the general narrative, which is now there for the footwear industry, which is that it is not showing impressive numbers, how much of that is true, and where do you stand in terms of your market share?
Yeah, so I believe that we have seen some normalization effects come in, right? So I think the consumer has spent their discretionary income on a lot of different things after having spent it quite generously on footwear for the 2 years after COVID. It's not that we see that the demand for footwear is changing. It's just that there's a buying shift that happens from season to season. The good news is a lot of the reasons we had a soft Q2 was the wedding dates, as we shared before. And when the wedding dates were more in line with what happened last year, you're seeing business continue to be the normal trend of double-digit growth out of Metro Brands.
The view as far as the overall demand environment is concerned, but talk to us about what's happening with Fila as well as Foot Locker, because we understand that there was some excess inventory which was there for Fila. Has that normalized now, and what plans for Foot Locker going forward?
Yeah, well, thanks for asking, because we're excited that we've done two things with Fila that are significant. One is that we finished our liquidation of all the existing old inventory that we had to clean up. And, we've always said that the first year of that, which was last year, would have been a cleanup year. So we were a little bit delayed, a little bit more delayed than I'd like to. But this year is going to be the repositioning year. And you can't reposition until you get rid of the old inventory. So the good news is the old inventory is gone. We've started doing some drops of Fila as early as September, October of the previous year. And that's starting to do well in our stores. And we're going to start to accelerate those drops as we build and reposition the brand. Starting in February, you're going to see more drops coming out of Fila. As far as the Foot Locker opening goes, as you know, we opened Foot Locker in Select City Mall, and we were quite pleased to see the sales there. It was challenging because, we ran right into the BIS regulations. And at that point in time, there was a little bit of a lull in shipments coming into the country. The good news is we know that center is now approving factories in Southeast Asia. So now we feel confident that once we have visibility of the BIS roadmap on how that affects our supply, we'll be able to come back and put together a good plan for Foot Locker openings. And we plan on opening a couple more stores by the middle of this year.
Okay, but since you talked about that BIS bit, could you talk to us about when do you expect the clarity to emerge on that? How are you gearing up for that? What kind of implications it can have on your financials?
Yeah, so actually we're not exposed from our Metro Mochi business. Our core business continues to remain strong. It's the businesses of Foot Locker that would potentially see some impact from it. You know, these things take a while to settle in. It's not an overnight thing as we get used to new regulations and factories adapt to that and adopt the practices required. So I believe that in the next few months, we'll at least have a clear roadmap of what is and what isn't. And at that point, you know, we would just have to make plans on how we best mitigate that. But again, I must emphasize that our core business of many of our banners are not affected by it at all. Specifically, Metro, Mochi, Walkway are not affected at all by it. You know, Crocs has also done some great moves on moving production to India, as are a lot of our other partners. So we were never had a high exposure to it because we planned on not having access to international manufacturing. And so as it plays out, you know, I don't believe it's going to be a huge risk to us at all.
Mr. Joseph, you know, the other thing I also want to talk about is store expansion, because from what we understand, you're expected to miss that 100 store opening target for FY25. Tell me, what's the overhang there, and then what's the plan for FY26 now?
So I think we all know that there's been a spate of growth in retail. And then I think there's, again, a little bit of normalization as some big retailers have reported net negative store growth in the previous quarters, right? What that does is it does hike up rents. You know, we are very cautious in how we open new stores. We want all our stores to be profitable. If you look at our store closure record, it's minimal compared to most retail. What that comes from us being prudent at times when you know, the demand is flying for retail space. Having said that, though, we are confident that we will come back and hit our target of 225 stores that we guided to over the 2-year period. This year is going to be right at 100 stores, as you said, but next year we'll just have to get that up to about 100 to 145 stores. And we're confident that the real estate inventory exists out there for us to do that with all our different banners.
Your current profit, I'm not using the word top line because top line may not be the right indicator, will come from your own brands, and how much will come from your licensed brands?
Yeah. So typically 70 to 75% of all the business we do comes from our own brands. And, you know, and that is a good margin driver for us. Having said that, though, we ensure that our licensed brands to the bottom line come in at the same, their margin, not margin dilutive at all to us, because a lot of costs are then managed by the brands as opposed to us, right? So if you look at product development costs that we have in our Metro Mochi banners, you know, we don't have any of those with a lot of the licensed goods. So you can't just look at it from a margin standpoint. You got to look at the flow through to the profitability. And that's why we pick our licensed brands very carefully to ensure that they're not dilutive to our overall margin and profit structure.
Right, Mr. Joseph, so good to have you on the show and chat with us about how the business is and how it's likely to be going forward. Good speaking with you.
Thank you.
If you like this video, then like, share and subscribe to ET Now.